ladies and gentlemen. Now, I know there's a lot of noise coming from outside, so to make it easier for all of you, I'm going to shout. And so if the people at the back there can't hear me absolutely clearly, please let me know. Can you hear me? Good. Well, if I speak loud enough, you'll be able to screen out the noise coming from outside. Now, we've only got 20 minutes, and there's quite a lot to say, so I'm going to go very quickly through the slides, and you have to pick up what information you can. It will be on the website later, but I'd like to leave time for one or two questions. Okay, we are a company, Red Rock Resources, resource-driven growth, natural resource developer. Look at those things on the left. Manganese production, ferrosilicon production starting right now in the next week or two. Colombian gold royalty, been there for a little while, but now beginning to pick right up. And we also have significant gold cash reserves. These are the key points on the left. On the right, other things that will play a part in the development of the company in future. There are not many companies on AIM, small exploration and mining companies, that have several sources of cash flow, and so they have positive cash flow now and are coming into positive profit. This reflects conscious decisions taken over the last few years. It's taken a few years to put ourselves in this position, but it means that we are no longer dependent on the market to finance our activities. We will be self-financing, and we will aim to restrict the number of shares that we have in issue. Here you see where we are active. Jupiter, South Africa, Steelmin, Bosnia, that's the old Yugoslavia, 4 Points, Colombia. That's where the cash flow is coming from, and Migori in Kenya, and then the due diligence on Congo, cobalt tailings, is a minor part of it. Second quarter, it says here operations update. This really means aspirations for the second quarter. Jupiter Mines, that's happened already. This past Wednesday, Jupiter listed on the Australian Stock Exchange, relisted, the largest mining listing since 2010, largest of this decade. The chief executive of the stock exchange came out in person to give a speech. The brokers said they couldn't remember the last time he did that. So this is a significant listing, and existing shareholders sold 20% in general of their stock. We've got 25% in public hands. No new money raised. Why? Because the company doesn't need it. Because by the end of May, the cash should have replenished itself in the underlying GP, 50% owned in South Africa, should have replenished itself to 1.5 billion rand. And that's off with only 3 months of the first 6 months operations included. So we sold stock. With good trading, there's a good chance Jupiter can become an index stock in Australia, which means all funds have to have it. As the payout policy declared in the listing document is to pay out 70% of funds raised, although we're very, very low cost there. We only have overheads of $3 million, so there's no reason to stop at 70%. We could pay out more, but based on a 70% payout ratio, if the manganese price can remain around $7, currently it's $7.42, then the dividend yield in the current year will be somewhere around 25% based on the IPO price of Jupiter. So very significant. Steelmin starting to produce in May 2018. Now, over a period of 8 months, we lent them money to complete a multi-year operation to bring that plant into production. We got repaid all of that within 8 months. On the back-to-back loan and on the currency, we made about 400,000, and that was very carefully thought about and planned by us, and we're left with a free, or actually more than free, 22% equity holding in Steelmin, which is targeting an annualized €7 million EBITDA based on the first furnace alone, but it's planned to open a second furnace there. European ferrosilicon prices have been at a multi-year high, up to $1,700 per ton, and currently at 1550 or so. So nice and high. When we looked at this in the middle of last year, we were talking of prices of 1,100, 1,150. These two things are happening right now. And although Jupiter has been providing cash flow from dividends, in the last month, we've therefore not only had a substantial £250,000 dividend, but we've got $1.8 million, or over £1 million, by selling a little bit of our stock to provide liquidity for the float. Colombia disposal, we are still getting principal payments from that. We get the last one of $750,000, $800,000 in less than a month's time. And we had the chief executive of that company in the office yesterday confirming that he is happy that they're going to be paying, and in fact saying, did we want stock or did we want cash? Which we'll think about. And we have royalties there which have been very slow to start because the refurbishment of the plant took them longer than expected. They put much more money in than they expected. They expected to put in a couple of $1 million. They put in $7 million. But our estimates now are not $80,000 a quarter, but within less than a year, we could easily be twice that figure of quarterly royalties from the gold operation there. Kenya, as I say, watch this space. And DRC, cobalt, copper, I came from a visit there within the last week, and again, watch this space. You'll hear from us on the due diligence there and everything. This is rehashing what you can see on the Jupiter website, what you can see on our website, and what you can see when this presentation's put up. Important thing to draw from this is get some feeling for what a big project this is. The biggest manganese exporter from South Africa after 3 years of operation, one of the top 3 operations in the world, and of those 3 operations, the only one that's going to be around for the next century. So this is an unbelievably good asset. And extremely well managed, I should say. So this is our stake and our interest. Bottom left, you can see the stream of dividends so far. As I say, this year we expect it to be much, much, much higher, plus the proceeds from a small sale into the IPO. Results for fiscal year 2018 for the underlying Chippy operation, as I say, 50% owned in South Africa. A blue chip. Steelmin, also a blue chip asset, because Steelmin is going to be selling to the major steel companies of Europe. That's its marketplace. And Yugoslavia, as you remember, was the most developed country in Eastern Europe, and it was a country that had the benefit of cheap hydropower, this is in the mountains, nearby sources of quartz, of carbon, of steel, and all the raw materials that are needed for ferrosilicon were nearby. It's a good plant put up by Norwegians, Germans, Italians in the Yugoslavia days, being refurbished, coming back into operation. It's well run. It will have good quality customers. Within the next 2 years, it will either acquire other businesses or it will be itself taken over. As I say, we have 22%. That makes us the biggest shareholder. And on 7 million euros EBITDA, could be a bit more, given current prices. We can put a multiple on that. What the multiple is, you'll have to look at the comparators and consider. Maybe 6-7 times EBITDA. If we had 2 operations rather than a single one, you might have 10 times EBITDA, so there you are. If we merge with someone else, there's a marriage value already. And we expect to see that company develop, much as Jupiter did, over the next year or two, to some kind of outcome that will be, again, favorable and will probably lead to a listing or to being bought by a listed company. Here again, the background that you can follow up on later. No time to go into in detail now. 4 Points Mining, Colombia. This was something that we brought into production by again putting in the last money, as with Steelman, and where we then sold out, but we sold out to good people. And we were very careful about that. So we structured the sale so that even though the gold market was low, we would eventually get a good return. As I say, we're getting something near $800,000 from that in the next month. And our royalty estimates for 2018, 2019, 2020, you see below there, could turn out to be conservative if what the company's been telling us is correct. And now the things that are the future. And again, we are looking to assets where we can get quick cash flow. Copper cobalt tailings. We're looking for tailings that potentially have 1.7% copper, so the same grade that a new hard rock mine would have in many parts of the world, or even higher. But this is tailings, it's there already. And with good, this is where the best cobalt in the world comes from, so reasonable cobalt grades too, maybe over 0.1%. As I say, we've done some due diligence there, continuing to do due diligence. I think because there are some instability issues in the Congo, not political instability, but there is going to be a change of government, possibly, that the contracts that have been done by the old government will be looked at carefully. The rule of law is not completely undoubted in Congo, and we are going to be very careful that what we do is buttoned up and secure in every possible way. And we will go ahead with this project if we can see a way to turn it very quickly into cash flows. And we believe we can. We have a strategy for that, but it still requires some more work. And it could be a real company maker. Cobalt, of course, is a very important metal for electric batteries, electric cars. Copper itself is important for electric cars, which use much more copper than ordinary cars do. Here again is a little bit of background on that. And here's an overview. I haven't said anything about Kenya. As I say, we're working on solving the issue there. African governments don't always play fair. We ended up having to take the Kenyan government to court. The last 2 or 3 ministers have wanted to settle this with us, and we are very close, we believe, to having a settlement. And one of the assets there would be a gold exploration asset with 1.2 million ounces, which we developed and defined. The other would be a tailings, copper gold tailings. So again, a tailings project with the prospect of early cash flow. So here's a summary of some other little assets in the background that could be developed later. But the key thing is we have £2.5 million cash in the bank already, with a lot more to come. We have 3 sources of cash flow. We want to make it 4. And we have multi-commodity exposure in some of the best commodities that are out there. What we have done with this company, we believe, is unique on AIM. It gives the company more security than any other on AIM, and the counterparties we deal with are some of the highest quality counterparties out there. Sure, we suffered, as other people did, when the market was bad for several years, but in the meantime, we didn't deviate from our long-term strategy, which is now beginning to come to fruition. And from here, we think that things are going to be much easier. Any questions? None? We do have a number of warrants. The only low-priced ones were 21 million at, I think, 64 cents, was it? 66 cents, which got exercised a week or 2 ago. We have 75 million exercisable by August, at a price of 0.8 compared with the price in the market of just over a penny at the moment. Of those, 20 million are at Beaufort's. We're not sure whether those clients are going to be in a position, unfortunately, to exercise them. Many of the rest will exercise. We then have some further warrants, 95 million, which would be exercisable by the end of November, again at 84 cents, I think. And after that, there is very, very little. Would we mind if all of those were exercised? I don't think we would. We'd get quite a lot of money in, as you can see. If we got, say, 150 million shares exercised at 0.8, we'd be getting another 600,000 or 700,000 pounds, which is our expectation. We'll probably get most of that money. And then we will be, again, very, very well cashed up for our future projects. Because what we did with Steelmin and what we'd done before that in Colombia, I think we're getting better at it. And something like Steelmin, where we can take a debt lender's risk for an uncapped equity return, is something we are in a position to do, we know how to do, and would represent a very good use of part of our shareholder funds and enable us to continue producing cash flow generation and asset growth. So some of the cash we get, we want to use for that, to give us a broader base of income-producing assets, and some, of course, we will need now in an improving market to use for exploration and development of existing assets. Though as soon as anything begins to look a bit lower grade rather than ultra-high grade or very large, we're going to seek partners to take most of the burden. We have no debt. We do have some creditors, so we obviously have a highly positive current position, current assets against current liabilities. We expect to unwind all those debt positions and have only cash soon.